Welcome back to Market Matters, your go-to series for simplified stock market concepts. In today's episode, we're covering a crucial yet often misunderstood topic: corporate actions and their impact on stock prices. Corporate actions are financial decisions taken by a company's board of directors that can affect the company's share price. These actions give us insights into a company's financial health and are key signals for investors. Dividends are a company's way of sharing its profits with shareholders. Let's say Infosys declares a 42 rupee dividend per share. If you own 100 shares, that's 4,200 rupees in your bank account. Nice, right? But here's the catch. Only shareholders before the ex-dividend date are eligible, and after the dividend is declared, the stock price often drops by the dividend amount. Why? Because the cash goes out of the company's books. Know the timeline. Dividend declaration, record date, ex-dividend date, dividend payout date. These determine who gets paid and when the stock price adjusts. In a bonus issue, shareholders receive extra shares instead of cash. Example, 2-to-1 bonus means you get 2 free shares for every one you own. So if you had 100 shares, now you'll have 300, without spending a rupee. Remember, the share price drops proportionally, but your total investment value stays the same. It's mainly done to encourage retail participation by making high-priced stocks more affordable. A stock split is similar to a bonus issue, but here the face value changes. For example, in a 1-to-2 split, a 10 rupee face value becomes 5 rupees, and your 100 shares become 200. Again, no change in investment value, but the per-share price comes down. This makes the stock more liquid and affordable, just like a bonus issue. In a rights issue, the company raises fresh capital by offering discounted shares to existing shareholders. Say there's a 1-to-4 rights issue at 400 rupees when the stock trades at 500 rupees. If you hold 4 shares, you get the option to buy 1 extra share at 400 rupees. But wait, you need to pay for these shares, unlike bonus issues. So subscribe only if you believe in the company's future potential. Sometimes the stock may even fall below the rights price, so stay alert. A buyback is when the company buys its own shares from the market. This reduces the total number of shares and usually pushes the stock price up. Why? Because it shows the promoter's confidence and improves earnings per share. Buybacks also help prevent takeovers and give existing shareholders a chance to sell at a premium price. Here's a quick summary. Dividends, profit sharing. Stock price drops post-ex-dividend. Bonus issue. Free shares. Stock price adjusts down. Stock split. More shares, lower price. Face value changes. Rights issue. Pay to buy more shares at discount. Analyze before buying. Buyback. Company repurchases shares, often seen as a bullish sign. If you found this helpful, give it a like and share it with someone learning the markets. Hit that subscribe button and tap the bell icon to stay updated on all upcoming episodes. Until next time, keep learning, keep investing.